Hello friends, welcome to this session for CMA intermediate students. This is your paper number 10, section B, titled as Financial Management. In this session, we are going to discuss the chapter named as Capital Budgeting. This chapter is little difficult, very interesting, and most important from the point of view of examination. You already know what is budgeting. Like in the cost accounting subject, you study what is budgeting. So budgeting means setting goals for the future. Budgeting means forecasting future. But in cost accounting, when you make a budget, it is mostly a revenue budget, maybe for a period of next 1 year. And it includes items of revenue nature only. But in FM, I don't make budget, I make capital budget. What difference does it make? When I say capital budget, it includes not only revenue items, but also capital nature items. And this is not for a period of say 1 year. This is for a period of maybe 5 years, 10 years, 25 years, or even the longer period. The question is, why do I prepare capital budget at all? So actually, whenever I want to invest my money in a long-term project, before investing money, at the time of taking decision, I actually prepare capital budget. Capital budget helps me to identify a good project which will result in a good performance in future. And try to recall the basic objective of financial management is wealth maximization. Wealth means value. Value is equal to performance divided by expectation. By making a capital budget, if I am able to choose a good project which gives high performance, then higher the performance, higher the value, higher the wealth, objective achieved. Okay? But capital budgeting decisions are very complex decisions, and following are the reasons. Number one, substantial expenditure. You also take many decisions in your life. Suppose you want to buy a calculator like this. So you'll have to take a decision. Which calculator should I buy? Should it be the Casio calculator or Citizen calculator or some other calculator? But the amount of expenditure involved may be 100 rupees, 200 rupees, 300 rupees at the most. In capital budgeting, you are trying to decide, should I start a new business? Should I invest 5,000 crore rupees in this new business? Substantial expenditure is involved, so that if it goes wrong, you will have huge loss. That's why capital budgeting decisions are very important decisions. Substantial amount is involved. Then the long-term time period. If you buy a calculator, the life of a calculator may be a year or 2 years or 3 years at the most. But when you start a new business, its projected life may be 25 years, 50 years, or even more than that. So you are taking a decision for a very long period of time, and that's why you need to be careful while taking the decision. And the third thing is irreversibility. Suppose you buy a two-wheeler for yourself, a bike. After riding it for a month, if you realize that no, you're not comfortable with this is not your type of bike, you can simply and easily sell it into the market. But what if you start a new business, suppose manufacturing of small size cars, and you put 2,000 crore rupees of investment, and thereafter you realize that there is no demand, there is no huge demand for small size, cheap value cars. So it is not easily reversible. Selling a two-wheeler in the market is really very simple. There is a market for used assets, but selling a 2000 crore rupees project in the market is no child's play. It's almost irreversible, or I can say it's very difficult to reverse it. Once you step in, it's very difficult to step back, right? Irreversibility. These 3 points make capital budgeting decisions very important decisions. Okay, so now you have one business proposal under consideration. You have to take a decision that should I invest money in this project or not? How do you evaluate the project? Is it a good project? Is it a bad project? Will it give better performance? Will it give average performance? Will it give not so good performance? How do you evaluate a project? There are various evaluation techniques. Some of the techniques are based on profits. Some of the techniques are based on profit. If the profit is expected to be higher, you accept the proposal. Otherwise, you don't start it, you reject it. And most of the techniques are based on cash flows. So there is one single method which is based on profits, and that technique of evaluation of a project is named as accounting rate of return or ARR. But almost all techniques of evaluation are based on cash flows. Now, all the techniques of evaluation which are based on cash flows, I can again divide it into two parts: non-DCF techniques and DCF techniques. DCF stands for discounted cash flow, means where you calculate present value. So in non-DCF, we have only one technique named as payback period method. Here you don't calculate present value of cash flows. While under DCF technique, you have four methods: the discounted payback period method, net present value method, internal rate of return method, and profitability index method. The most important method here is net present value method. In examination, the highest probability of a method being asked is NPV method. Okay. So now you know the name of techniques of evaluation. Let's discuss types of business proposal you may have under consideration. I can broadly divide proposals into two categories. One is independent proposal and one is mutually exclusive proposal. So when you appear in CMA intermediate examination, you and your friend and many other people, thousands of students, all of you are independent proposals for ICMA. If I pass, my friend will fail, nothing like that. Both of us can pass, both of us may fail, one of us can pass. We are not dependent on each other, we are independent of each other. One who crosses the cutoff level of 50% will be declared pass. So if a proposal is not dependent on other proposals, it is called independent proposal, and decision taken in this case is based on some cutoff, some threshold point. Then there comes mutually exclusive proposal. After becoming a cost accountant, suppose you go for a job interview, there is only one vacancy and 5 candidates are present for the interview. If any one is selected, remaining 4 will be rejected for that particular job. Now all 5 candidates are mutually exclusive proposals for the interviewer. If one is selected, all other are automatically rejected. So here the decision criteria is very simple. You choose the best proposal you choose, and remaining will be automatically rejected. You must have noticed that out of many techniques of evaluation, There is only one technique which is based on profits, and all other techniques are based on cash flows. So it is important to calculate cash flows, to learn to calculate cash flows. For the sake of ease, cash flows may be classified. Classification is not compulsory. When you eat food in your thali, you classify food. You'll take sambar or dal in a separate bowl, katori, and there are different bowls, there are different small plates, and then there is one big thali. Your food is classified into various categories. It is not simply you take a big bowl and pour everything into it, you mix it up and start eating it. So, for the sake of convenience and better understanding, all the cash flows may be classified into annual cash flows, initial cash flows, and terminal cash flow. At the start of the project, various cash flows that occur are named as initial cash flow, like purchasing the land, constructing the building, buying the machinery, buying the fixtures and furniture, buying vehicles, making investment in working capital. All these activities, all these cash flows are called initial cash flows. Then the most complex calculation is of annual cash flows that we are going to learn. And what do I mean by terminal cash flow? So when you wind up this project, when you close this project, terminate this project, then by selling various assets and realizing working capital, whatever amount you receive is named as terminal. So the name itself is clear. At the beginning, one time it is initial. At the end, one time it is terminal. Meanwhile, every year, year by year, first year, second year, third year, and so on, it is annual cash flow. So the most complex calculation is actually for annual cash flows. How do I calculate annual cash flows? A simple format will look like this. I'll start with the amount of sales. And then I will deduct purchase. So when I sell goods, I receive cash. This is inflow of cash. I sell goods, I sell services, I receive cash. This is inflow of cash. Now, to sell goods, first I need to purchase it. When I purchase goods, I pay for it. It's an outflow of cash. Besides, I have some other expenses, salary, rent, electricity. So you can call it factory overheads, administrative overheads, selling overheads, etc. So when I pay for other expenses, it is also an outflow of cash. So inflow in most of the question will be in the form of sales, but outflow, in different questions, its nomenclature will change. Sometimes they'll say raw material, wages, factory overhead, administrative overhead, selling overhead. Sometimes they will simply say cash outflow for expenses. And sometimes it is simply purchase and other expenses. Nomenclature is not important. Whatever expenses, revenue nature expenses you are making, it is an outflow of cash. So inflow of cash minus outflow of cash gives you cash profit. My cash income is 50,000. My cash expenses are 36,000. So my cash profit is 14,000. So far, I have not deducted income tax. Suppose the amount of income tax is given in the question and it is 2,400 rupees. If I know the amount of income tax, it is given ready-made, then I'll simply deduct it from my cash profit before tax to arrive at cash profit after tax. Cash income minus cash expenses gives me cash profit before tax. Now tax is 2400. So my cash profit after tax is 11,600. But in most of the questions, they don't give you amount of tax. You are supposed to calculate income tax yourself. And you already know that for the purpose of income tax, depreciation is a deductible expenditure. So my cash profit was 14,000, I agree. But my non-cash expense is 6,000. Tax authority says, okay, you can deduct it. So definitely I deduct it to reduce my tax burden. See, this was my cash profit and this is my profit. What is the difference? Cash profit means before charging depreciation and profit means after charging depreciation. If the tax rate is 30%, 8,000 into 30% will give me 2,400 rupees of income tax. If I deduct income tax, I'll get profit after tax. Now depreciation was deducted just to consider its tax benefit. Otherwise, it's a non-cash item and I'm calculating cash flow. So to nullify its effect, I'll add back depreciation. And this is how I get cash flow after tax. I hope you got it. That if tax is given ready-made, neither you need to deduct depreciation, nor you need to add it back. But 99% of the time, they don't give you amount of tax. So first you deduct depreciation, then you deduct tax, then you add back depreciation to arrive at cash profit after tax. These are steps for calculation. There are shortcuts also. In due course of time, we'll discuss about those shortcuts. Okay, let's do one quick question. Now, don't expect that notes of these questions will be provided. This is not really a tough and very important question. This is just a concept checker. To understand the concept properly, this question is framed. Still, if you fall in love with this question, take a screenshot or simply jot down it in your copy. Lot of questions are available in your own study material as well as in past examination question bank. Okay, so here we are interested in calculation of annual cash flow. And situation says that a project requires initial investment of rupees 50,000. Life of the project is 4 years. Fine. Initial outflow is 50,000. Life is 4 years. Scrap value is negligible. That is 0. Scrap value means salvage value. Cash flow before tax is given. Okay, so thank God we have landed here in the question, CFBT. Sales minus cash expenses. This is already done and a ready-made figure of CFBT is given. So we now just need to carry it forward up to CFAT. This is 15, 15, 20 and 25,000 for coming 4 years. Find out cash flow after tax if the tax rate is 30%. So, my dear friends, we'll make calculations in these steps. See, if it is a single year's calculation, I'll make a statement. One, wide column for particulars and one narrow column for amount if a single year's calculation is required. But if the calculation is required for multiple years, then I'll prefer to make a table, not a statement. When I say statement, particulars, amount. When I say table, it may be year 1, 2, 3, 4, so on, right? So I'll take year, then I'll take CFBT as given in the question. Then I'll calculate the amount of depreciation and deduct it to arrive at profit before tax. Then I'll calculate the amount of tax and deduct it to arrive at profit after tax. Then I'll add back depreciation to arrive at cash flow after tax. How do I calculate these figures? Simple. You want to calculate profit before tax? It is cash flow before tax minus depreciation. You want to calculate tax? It is profit before tax multiplied by tax rate. You want to calculate profit after tax? It is profit before tax minus tax. You want to calculate cash flow after tax? It is profit after tax, add back depreciation. So, in the first year, CFBT given as 15,000. Now, let's calculate depreciation. That's simple, isn't it? 50,000. Question is silent about method of depreciation. So, I'll assume straight line method of depreciation. Straight line depreciation is equal to cost of the asset, which is 50,000 rupees, minus salvage value, which is 0, scrap value, salvage value, terminal value, whatever you name it, divided by life, which is 4 years. So depreciation is 12,400 in examination. You should give a working note for depreciation calculation like this. Or even better presentation can be made. So look here, depreciation is 12,500. I deduct depreciation to arrive at profit before tax, which is 2,500. Then 30% is the income tax, which is 750 rupees. Then I deduct 750 from 2,500 to arrive at profit after tax of 1,750. And then I add back depreciation, 750. No, not 750. Depreciation is 12,500. So 1,750 plus 12,500 is 14,250. Right. Now, exactly in the same manner, calculation for rest of the years can be done. I told you earlier, and now I'm repeating, that at any point in time in this video, if you feel that I'm moving at a faster speed, then you can simply pause it, rewind it, rewatch it, and vice versa. If you feel like you already know, you can kind of forward it or play it at a higher speed. Okay, now let me give you a very simple tip. How do I calculate profit after tax? It's profit before tax minus tax, obviously. How do I calculate amount of tax itself? So, it's here. How do I calculate amount of tax? It is simple. I take profit before tax and multiply it by tax rate. Now look here, PBT minus PBT into tax rate. If PBT is taken out common, you have got a formula. PAT is equal to PBT into 1 minus tax rate. Like in the first year, your PBT was 2,500. You simply multiply it by 0.7 and you'll get 1,750, and you won't have to make a column for income tax. From PBT, you can directly arrive at PAT. Okay, good. But what if there is a loss? See, here in this question, PBT was positive for all 4 years. If PBT is negative, it means there is a loss. You need not to pay income tax. In fact, you should not pay, I'll say. So let's do one quick question on this. From the following particulars, calculate post-tax cash flows assuming a tax rate of 40%. Okay, fine. Income tax is 40%. Post-tax cash flow, CFD is to be calculated. Initial investment 1 lakh, salvage value nil, depreciation straight line. And life, look here, cash flows are given for 4 years. It means that life is 4 years. So 1 lakh minus 0 divided by 4 gives you depreciation of 25,000 rupees. S7, if the question, here the question itself is guiding straight line method. If question is silent, you will obviously assume SLM. Profit before depreciation and tax. Mind it, this is before deducting depreciation and before deducting income tax. Look here, this 14,000 rupees is before deducting depreciation and before deducting income tax. And how do you name it? Profit before depreciation and tax. You name it as CFBT, right? So in this question, this one. In this question, these 4 figures of 10,000, 10,000, 20,000 and 80,000 are nothing but CFBT. Assume that company has other profitable business activities. This paragraph I'll deal later. So I know CFBT, I know the rate of tax, and I'm supposed to calculate CFAT. So again, I'll create a table with these headers. Okay, wait a minute. So what do I do now? That I'll say, okay, my first column is for year. Then this is cash flow before tax, CFBT. I have skipped the column of depreciation because depreciation is same each year. So I can keep it here. I need not to note it down. I deduct depreciation to arrive at PBT. Then I'll calculate tax. Then I'll deduct it to arrive at PAT. And then I add back depreciation to arrive at CFAT. So look, there are 4 years. CFBT given in the question is 10, 10, 20 and 80,000. Depreciation, we have identified it to be 25,000 rupees. Now 10,000 minus 25,000 depreciation is negative profit. That is loss of 15,000 rupees. Next year, same 15,000 rupees of loss. Then 20,000 minus 25,000, a loss of 5,000 rupees. Then 80,000 minus depreciation of 25,000 gives you PBT of 55,000. Observe here that for first 3 years you sustained a loss, and in the 4th year you made a profit. You must have studied income tax, and you know that income tax is payable only if there is a profit. If there is a loss, then you don't pay income tax. So in the first year, there was a loss, and so your tax liability is zero. Second year, again you sustained a loss, no tax. Third year, again you sustained a loss, no tax. But in the fourth year, you made a profit of 55,000 rupees. But in Income Tax Act, you must have studied that if in any year you sustain a loss, whether it is a business loss or it is unabsorbed depreciation, you can carry it forward to the next year and next to next year and next to next year and next to next year. And whenever you earn a profit, you are allowed to first set off, that is deduct, the carried forward loss and pay tax on remaining amount. Here, if you observe, your carried forward losses are 35,000 rupees. 15,000, 15,000, 5,000. 35,000 of accumulated loss, carried forward loss. Then you made 55,000 rupees of profit, right? So, how do I calculate tax for the fourth year? I made a profit of 55,000, but I have carried forward losses of 35,000. I'll first deduct it, and 20,000 is my taxable profit. Though my accounting profit is 55,000, but my taxable profit is just 20,000. On this profit, I'll have to pay 40% tax because that is the rate of income tax given in the question. See here, 40%, right? So 8,000 will be my outflow of cash for payment of tax. This is the treatment assuming that the loss is carried forward. Now, first 3 years are quite obvious, 15, 15 and 5,000 loss, no tax. So profit after tax is also the same amount, loss of 15,000, 15,000 and 5,000. But here, your profit was 55,000, your tax bill is 8,000. And that's why profit after tax is 47,000. Some students can commit a mistake over here. They may think that my profit is 20,000, my tax is 8,000, and that's why my profit after tax is 20,000 minus 8,000 is equal to 12,000. No, never. 20,000 is not the profit. 20,000 is the taxable profit. Your cash profit, means profit for fourth year is 55,000, on which you are supposed to pay 8,000 as tax. So your profit after tax is 47,000. Okay, once you obtain profit after tax for all 4 years, now the next thing is to simply add back depreciation of 25,000 rupees. So minus 15,000 plus 25,000 is plus 10,000. Again plus 10,000. Now 25,000 added back. Third year it is 20,000. And then 47,000 plus 25,000 gives you 72,000. So this is how you treat it in case PBT is negative, that is there is a loss. See, carry forward of the loss is done assuming that this is the only business the company is having. And that's why the loss is there, carry it forward and then set it off. What if I have one more existing business activity, and that activity is highly profitable business activity. I'm running a business, it is highly profitable. Now I have one proposal under consideration for evaluation. This project is expected to give me losses. So I need not to carry forward the loss. See, if I'm one company and I'm running two business, I don't file two income tax returns. I file one income tax return as a company. So one business is a profit, other business is a loss. I cancel it, I'll set it off in the same year. I won't carry forward the loss. And that way, I'll reduce my tax burden for my existing profit making business. So if I assume that I have other business activity and that other business activity has a profit, in that particular case, I will have to set off the loss in the same year. See, same table I'll make. Now, as far as first year, 1, 2, 3, 4 years are there. CFET, CFBT is also same. PBT is also same. So calculation up to PBT is exactly same. Look here. PBT 15,000, 15,000, 5,000 and 55,000. And here in this table also PBT is same. But now next step will change because now the assumption is being changed. Now I'm assuming that I'll have to, I don't have to carry forward the loss. I'll set off the loss in the same year. So what do I do for that? If there is a loss of 15,000, see, assume it like this. On profit, I pay tax. So on loss, I will receive tax. 15,000 into 40% is 6,000. And this is not payment of tax. This is kind of receipt of tax. Again, in the next year, there is a loss. So I won't pay tax, I'll receive tax. So exactly, it's not like that Government of India Income Tax Department will give me a check of 6,000 rupees. No, no. I'm receiving tax doesn't mean I'm receiving a check or I'm receiving the cash. It simply means I was paying higher amount of taxes. Now due to this set off, I am paying lower amount of taxes. That avoidance of outflow is actually inflow. So suppose I was otherwise paying 20,000 rupees as my income tax. Now due to this set off of the loss, I'll be paying say 14,000 rupees as income tax. So the 6,000 reduction in outflow, avoidance of outflow is actually inflow. You simply name it as tax benefit or tax shield. On 5,000, I'll get tax shield of 2,000. Now there is the profit. So I'll have to pay tax. This is not tax benefit. This is tax expense. Okay. Now to give you more clarity, like how come this 6,000? Calculation is simple. You take 15,000 multiplied by 40%, and this is how it is 6%. So suppose my existing business has a profit of 50,000 rupees, and that's why I'm paying tax 50,000 into 40%, that is 20,000 outflow. But this proposal under consideration has a loss of 15,000 rupees. See this clause, 15,000. So my net profit is just 35,000 rupees. You see? And that's why on 35,000 at the rate of 40%, I'll have to pay a tax of just 14,000 rupees. So otherwise, I was supposed to pay 20,000 as income tax on my existing business. But due to this proposal, there will be a loss. It will be set off in the same year. My taxable profit will reduce. My tax burden will reduce from 20,000 to 14,000. This avoidance of outflow is actually an inflow, right? This avoidance of outflow is actually an inflow. And that's why I said that show inflow of cash. Right, guys? So, what do you do in examination? See, if a question is silent, always assume that there is other business and hence you will set off the loss in the same year. But if question specifically mentions that no, company does not have any other profitable business activity, or if question says a new company is going to start its first business, then take a hint that you don't have any other business. In that particular situation only, you should carry forward the loss. Otherwise, if the question is silent, always assume that I have other profitable business activity, and that's why if there is a loss, I'll take the tax benefit. Right? Okay, fantastic. Look here. See, after calculating tax, rest of the steps are easy. So here 15,000 of loss, 6,000 of tax receipt, tax benefit, and the net loss is 9,000. Here also the net loss is 9,000. Here also, the net loss is 3,000, 5,000 negative, 2,000 positive. And here you made a profit of 55,000, hence you paid tax 22,000. That's why this is 33,000. And then add back depreciation, which was 25,000. So, if you carry forward the loss, your cash flows are like 10,000, 10,000, 20,000, and 72,000. And here your cash flows are like 16,000, 16,000, 22,000, and 58,000. Cash flows have changed. If you simply make a sum total of all these cash flows now, you'll get the total equal to 1,12,000 over here. 10 plus 10, 20, 20 plus 20, 40, 40 plus 72, 1,12,000. And here also, if you make a total now, again you will get 1,12,000. Isn't it surprising? See, in both cases, you are getting the tax benefit. In first situation, you are getting it later. In second situation, you are getting it simultaneously in the same year. But tax benefit is available in both cases. And that's why if you make a sum total without calculating present value, it will be same for both cases. It will be same for both cases. But it makes a difference. These two are not same. Because the next step maybe you calculate present value. So if you calculate present values, this second situation, that is set off the loss in the same year, will be better, because here you are getting cash flows faster in the first and second and third year itself, and that's why this option will give you higher present value of cash flows. See, what I said is total cash flow is same in these two columns, but this one is better because here you get it earlier and here you get it later. What to do in exam? This one, if the question is silent. Do this one only if question specifically says it or gives some hint about it. Okay. Now, the next concept to learn is treatment of working capital in capital budgeting. I hope you know what is working capital. It is current assets minus current liabilities. So just like you need fixed assets for doing the business, you make investment in fixed assets, you buy land building. Similarly, you put your money, you make investment in working capital also, stock, debtors, cash, creditors, etc. So the very simple treatment is, if a question says that if you do this business, working capital requirement is 5 lakh rupees and life of the project is 10 years. So at 0 year, that is at the inception of the business, show outflow of 5 lakh. You'll have to invest money, 5 lakh rupees in the business. And at the end of 10th year, same 5 lakh rupees should be treated as an inflow. Just listen carefully. If you buy fixed assets in a business and sell it out after 10 years, the situation will be different. If I buy machinery, 0 year, 5 lakh rupees outflow. 10th year, the inflow may be, say, 50,000 rupees because there is a wear and tear, the machine has been depreciated, and that's why I realize a lower amount, salvage value, scrap value. But try to recall, you never charge a depreciation on working capital, isn't it? So if you invest 5 lakh rupees at 0 year, you will receive same 5 lakh rupees back at the end of 10th year. Okay. So initially outflow, same amount inflow at the end of life of the project. But what if working capital keeps on changing year by year? In that case, the treatment is simple. If the amount of working capital rises, the difference amount should be treated as an outflow of cash in that year. And if the amount of working capital falls down in any year, the difference amount should be treated as an inflow. Increase in working capital means you are investing further money, so it is an outflow from your pocket. Decrease in working capital means you're taking back your money from the business, and that's why it will be an inflow in your pocket. Okay. So look here, there is one quick question. Example. Here 0, 1, 2, 3, 4. What is 0 year? It is the point of time where you are taking decision. There is nothing like 0 year in this question. It's simply the starting point. Suppose you estimate that at the start of the business, working capital requirement will be 25,000. By the end of first year, the business size must have gone up. So working capital will be 45,000. In second year, no change in business size, working capital remains same. In third year, business is coming at a downturn, it is falling. So working capital requirement also reduces to 5,000 rupees level. And at the end of fourth year, you will close this business. So working capital requirement will not be there. So now what are the cash flows for this working capital? At 0 year, I'll show outflow of 25,000. Now, as compared to 0 year, see 0 year working capital was 25,000. First year it goes up to 45,000. 25,000 was already there. Now it has gone up to 45,000. So there is an increase of 20,000 rupees. And that's why I'll show 20,000 rupees as an outflow of cash at the end of first year. And in second year, working capital remains same, so no cash flow. Then in third year, working capital reduces from 45,000 to 5,000, and that's why the reduction is 40,000. This is an inflow of cash. Then it reduces to 0 level from 5,000 level. It means there is a reduction of 5,000. See, increase is an outflow, decrease is an inflow. But just be careful about one thing. and that is this cash flow should not be treated before tax. Like we prepared this table, this one. If somebody asked me to adjust working capital outflow here, so I'll not deduct outflow due to working capital before deduction of tax. Otherwise, I will be unnecessarily taking tax benefit on working capital, which is actually not available. So if you want to adjust working capital cash flow, it should be after treatment of tax. Be careful. It should be after treatment of tax. Or it means here or here or here, you should treat working capital cash flow. Or a better way will be to treat it separately. Like don't, include it in the annual cash flow table. Make a separate table like this for working capital and calculate its present value separately. That will be a better idea. Okay. Now, after calculation of cash flows, let's talk about methods of evaluation. So I'll first talk about the payback period method. What is payback period method? It is the length of time required to recover initial investment in a project. Length of time required to recover initial investment in a project. So if you are making investment of 5 lakh rupees and this 5 lakh rupees principal amount alone will be recovered say in 3 years, then I will say that the payback period is 3 years. If the annual cash inflows are equal, I'll say that payback period can be calculated with the help of this formula, which is initial investment divided by annual cash flows. For example, if initial investment is 100 crore rupees and annual cash inflow is 20 crore rupees, so 100 crore divided by 20 crores gives you 5 years of the payback period. Payback period is 5 years over here. And for payback period, I can say shorter the better. If I have payback period of 2 mutually exclusive proposals, proposal A has a payback period of 5 years, while proposal B has a payback period of only 3 years. And obviously these are mutually exclusive proposals. So I have to choose one of these two. I'll choose B proposal because it has got a lower payback period, that is 3 years. But in case of a single independent proposal, how do I take decision with payback period method? Definitely I need a cutoff period. Suppose the management decides that the cutoff period is 4 years. Now if I calculate payback period for a project and it appears to be 5 years while cutoff is 4 years, I definitely reject this proposal. On the other hand, if cutoff is 4 years and my payback period for a project is just 3 years, I'll accept that proposal. So in case of independent proposal, if payback period is less than the cutoff period, I will accept the proposal. If it is more than the cutoff period, I will reject the proposal. In case of 2 mutually exclusive proposals, I'll accept a project with lower payback period. Now, there are several advantages of the payback period method. Number one, this is easy to understand and simple to calculate. You must have observed that it is the simplest method in this capital budgeting chapter. It also gives you a ready and rough idea about the risk of the project. Shorter the payback period, lower the risk. Longer the payback period, higher the risk. You know why? Suppose the payback period is just 3 years instead of 5 years. You select a project with 3 years payback period and reject the proposal with 5 years payback period. After 3 years, suppose there is a sudden downturn in the entire economy and therefore your business also start performing poor and you start sustaining the loss. But thankfully, you have already recovered your initial investment. So if the payback period is shorter, your principal amount is recovered soon. Thereafter, if any adverse event happens, you will not suffer loss of principal amount at least. There are disadvantages also of this method. Number one, it does not consider time value of money. Payback period method does not consider time value of money. You are simply adding first year, second year, third year, fourth year's cash flow. You are giving it equal importance. It does not consider time value of money. The solution to this problem is given in discounted payback period. Number two, it also ignores cash flows beyond the payback period. So once the payback period is achieved, rest of the cash flows are totally ignored. So suppose two mutually exclusive proposal, one has a payback period of 3 years, while the other has a payback period of little higher, 3.5 years. You will reject this 3.5 year payback period proposal and you will select this 3-year payback period proposal. But suppose in this proposal, after 3 years, the cash flows are zero. That is, the life of the project comes to an end. While in this 3.5 year payback period proposal, in 4th year, 5th year, 6th year, 7th year, 8th year, 9th year, 10th year, there are huge inflows. But you have taken decision on the basis of payback period. Hence, you have selected a project which does not give any cash flow after the payback period and rejected a project which gives huge amount of cash flow after the payback period. Now, that's another weakness of payback period method. This method is very suitable in case of industries where the risk of obsolescence is very high. So if shorter the payback period, even if the machine becomes obsolete, even if the business comes to an end, at least you have recovered your principal amount. See, in case of equal cash flows, you can simply use this formula, right? Initial investment divided by annual cash flow. But if the cash flows are unequal, how do you calculate payback period? Here we'll take one example. So initial investment is 2 lakh rupees. Scrap value is nil. Scrap value is nil. Useful life is 5 years. Profit before depreciation is given. Let's assume this is not only before depreciation, but also before tax. So I'll say this is profit before depreciation and tax. That is CFBT is given. For first year it is 1 lakh rupees and then 1 lakh, 80,000, 80,000 and 40,000. The given figures are CFBT. First I'll convert it into CFAT and then I'll calculate payback period. Depreciation, if I calculate 2 lakh minus 0 divided by 5 years, so that's 40,000 rupees. Look, I'll make a table like this. So first of all, I'll make a column for years. Year 1, 2, 3, 4, 5. Then I'll put CFBT as given in the question. 1 lakh, 1 lakh, 80,000, 80,000 and 40,000, right? And thereafter, what do I do? I'll deduct depreciation of 40,000 rupees to arrive at profit before tax. If I deduct 40,000 rupees, it will be 60, 60, 20, 20 and 0. Then the tax rate is 35%. So profit before tax will be simply multiplied by 0.65 to arrive at the profit after tax. 60,000 into 0.65 is 39,000. And 40,000 into 0.6 is 26,000. Then 26 repeat and then 0. I'll add back depreciation, which is 40,000 rupees to arrive at cash flow after tax. 79, 79, 66, 66 and 40,000. And I want to calculate the time period within which the initial investment of 2 lakh rupees will be recovered. So I'll make a table, I make a column of cumulative cash flows. I hope you know how to calculate cumulative cash flow. First year it is 79,000 itself. For second year it will be 79 plus 79. that will be 1,58,000. For the third year, it will be 1,58,000 plus 66,000. That is 2,24,000. Then for the fourth year, it is 224 plus 66. That is 2,90,000. Then 2,90,000 plus 40. That is 3,30,000. So I have prepared a column of cumulative cash flows. And look here, I want to recover 2 lakh rupees, right? So in the first year, 2 lakh is not recovered. In the second year also, 2 lakh is not recovered. In the third year, I have recovered more than 2 lakh rupees and actually 2,24,000. So my payback period is more than 2 years, but it is less than 3 years. I will simply use a unitary method over here. What do I mean by unitary method? See, by the end of second year, I have recovered 1,58,000. I need only 42,000 more to recover the initial investment of 2 lakh rupees. But here I am not earning 44,000. Here I am earning 66,000. So I'll use a unitary method since 66,000 rupees takes 1 year, then 1 rupee will take 1 by 66,000 year to recover. So 42,000 rupees will take 42,000 by 66,000 years to recover, right? If I present it in the shape of a formula, I'll say that my payback period is more than 2 years. So 2 years plus I need to recover 42,000, while in the third year I'm recovering 66,000. So 42 by 66, it will take 0.63 years, not the whole third year, but just 0.63 years. So this way it is 2.636 years. My payback period is 2.64 years, I can say that. Or if I convert it into months, I can do it like this, 0.636 into 12 months, 7.6 months. So I can say that my payback period is, it is 2 years and 8 months. I have rounded off 7.6 to 8. This is how I calculate payback period in case of unequal cash flows. All right. Thank you. So see you in the next session. Till then, bye-bye. Thank you.